Well, hello and welcome to this special Fenix Material Acquisition Investor Briefing webinar, which is being held following the release by Fenix this morning of an announcement titled Fenix Acquires 290 million tonne Weld Range Iron Ore Project. My name is Mick Colliss and I'll be hosting today's webinar, and joining me will be Fenix Executive Chairman John Welborn. Now, today's live webinar is being held via Automic's online meeting platform, which allows shareholders to participate by asking questions, so they can be submitted at any time. If you haven't used the system before, you'll find the Q&A icon just at the bottom of your screen. Just simply click on that icon. That will open a new separate screen, and at the bottom of that screen is a section for you to type your question. We'll try to get to as many as we can, but if we do run out of time and we don't get to yours, then just please feel free to email the company directly using the contact details on the Fenix website. But to get us started, it's now my pleasure to introduce the chairman of Fenix, John Welborn. And John, very exciting news from Fenix this morning on the acquisition of that 290 million tonnes Weld Range Iron Ore project. Tell us what this does mean for Fenix.
Thanks, Mick. It's obviously a game changer for Fenix, as I've described in my comments in today's announcement. We have a foundation partnership with Sinosteel Midwest Corporation, who are now a subsidiary company of the world's largest steelmaker, Bow. And today's announcement provides us with an enormous inventory of available mineral resources. So Fenix is described as an integrated miner transport logistics company. We have three pillars to the business: a mining business, a transport logistics business, and our shipping and port services business. But we have been seen as all hat and no cattle, because we have a port that can do more than 10 million tonnes per annum. We have a scalable transport logistics business. But traditionally, we've mined small isolated deposits in the Midwest. What the Weld Range project provides Fenix is decades of available mining in the Weld Range. High grade, high quality, direct shipping iron ore. We have an exclusive right to mine. It's a 30-year agreement. It continues the relationship with Sinosteel. It starts a very strong commercial relationship with Bow. The terms are fantastic for Fenix. We don't need to raise any money. And this is a continuation of our existing business. We have guided for the current financial year that we'll produce between 4 and 4.4 million tonnes per annum. And the market can now see where that future production will come from. So to maintain our existing production, we now have an abundance of available choices of where to mine, including the balance of the BW11 project, the mine we've just commissioned, which is a 20 million tonne deposit. But as you can see on the map on today's announcement, we're surrounded by the Weld Range project and its 290 million tonnes of available iron ore. And so we now have a clear pathway of expanding. We have often identified the capacity to export 10 million tonnes a year from Geraldton. And now we're working on the feasibility study that will show the market how we can get there, how quickly, and what that will do to our cost structure. We've been very proud and made a lot of money by producing iron ore at roughly 75 Australian dollars FOB Geraldton. We're very confident that the expansion of our mining in the Weld Range will give us the opportunity to target a much lower cost at higher volumes. So yes, it's a very exciting agreement for Fenix. It's a very exciting agreement for the Midwest and even for Western Australia. The abundant iron ore resources of the Midwest have been stranded for decades. And we are delighted to now have the opportunity to monetize, along with our partners Sinosteel, those iron ore resources. So we're looking forward to continuing to build our business.
So it's obviously big news for Fenix, and you're obviously very happy with the deal. And see the share price opened this morning at 35 cents, which is up around 10%. Are you surprised by that?
Well, I'm surprised it hasn't moved more, Mick. And thank you. Yes, I am excited. My fellow executive director, Craig Mitchell, popped into my office moments ago and asked me to breathe and calm down and make sure that I slow down. So please do interrupt if I get too excited. Look, it's obviously very pleasing to see that we've opened up this morning on strong volume. I think that there's a long way to go with Fenix, and you can see that in the incentive structures that are put in place. We think the share price has a lot of appreciation to go. But our focus isn't on the share price, it's on building a business. And the important part of today's announcement, Mick, is that we've, Craig and myself and the whole team at Fenix have been working on this for a long time. The announcement discloses that we've started a feasibility study. Effectively, that feasibility started years ago and the market has seen that with our investment in the Riverdini Inland Port, with our investments in improving our Geraldton Port infrastructure. They're not motivated by our transition from 1.4 million tonnes to 4 million tonnes per annum. They're motivated by the opportunity to build a large-scale, low-cost miner in the Midwest. So there are a number of things. This announcement really supercharges what we've already been working on. The sightline on the expansion of our new haul business, the expansion of the fleet, and significantly future opportunities for innovation are very exciting. And they're now supported by hundreds of millions of tonnes of iron ore that we have the opportunity to mine, haul and ship to our customers.
You may have almost answered my next question. So you used the word transformational in the release and described the deal with Baowu as a game changer. So why is that? I guess that's part of the reason you just talked about.
Look, I think it's around having the available inventory. Game changing is really relevant because if you think about the development of the Iron Ridge mine behind me, it was around focusing on what is the highest grade ore body in mainland Australia and mining that at an incredibly capital efficient rate. So Fenix raised, the last time we raised capital from the market was in 2020. It was a $15 million capital raise, and we built the entire business on operational cash flows. So a key part of today's announcement is we intend to continue to do that, generate cash and reinvest it into the business to create future huge earnings for Fenix to be able to reward our shareholders with. And so that game changer now, though, is instead of having relatively small finite ore bodies and managing short mine lives, we now go to all intensive purposes at our current production rate of having almost what feels like infinite tonnes. And so the game changes. We're now on a pathway to reduce our operating cost, increase our volumes, and capture the enormous economic rewards that we see that are possible there. So our game has changed. Fortunately, we've been working on changing our game for a long time. And I often described the 10 million tonne right to mine that we secured from Sinosteel in October of 2023 as the keyhole to which we were going to unlock the rest of the Weld Range. This agreement, effectively a right to mine the balance of the entire portfolio of the Weld Range projects owned by Sinosteel, is the fruition of that focus. And it's a testament to us demonstrating, the entire team at Fenix across our mining business, our haulage business, our port business, demonstrating to our partners that we have the capacity to unlock the Weld Range.
So you talk about this, the right to mine. So this acquisition is a right to mine agreement. What does that actually mean? And can you explain the conditions of that agreement? And I guess more importantly, what that deal will cost Fenix?
We have an exclusive license to mine and sell the iron ore on the Sinosteel tenements in the Weld Range. And the terms of that agreement are outlined in detail in the announcement. The summary is that the upfront payment is $60 million in cash, and that's paid over 24 months. So immediately we're paying $20 million cash, and we finished the financial year with $56 million of available cash on our balance sheet. So that's a payment that we're ready to make. And then we make a further payment of $20 million cash in 12 months and a final payment of $20 million cash in 24 months from signing the agreement. And then there's also a royalty, which is structured to incentivise us to produce more tonnes. And so it's a sliding scale from 5 Australian dollars a tonne below certain volumes, and it reduces to $4 a tonne if and when we get to more than 8 million tonnes per annum. And that really is an indicator of what Baosteel and Sinosteel are looking for from Fenix in this agreement. They want to see us boost our production, and there's an incentive to do so by bringing that royalty rate down to $4 a tonne. And then there's also a profit share, which is based on the net profit after tax from the Weld Range project. And that is 10% below a prevailing iron ore price of $100 a tonne and 15% above that. Outside of those considerations, the cash, the royalty and the profit share, Fenix receives 100% from the sales of iron ore, and we're entirely in charge of our operations. The capital we spend, the efficiency and cost that we generate is under our control. And our partners, Sinosteel, receive the consideration I've outlined. So it's a very flexible arrangement, and it provides a significant incentive for Fenix to boost our production.
So there's no problem in covering the cost of that acquisition?
No, and the important thing looking at this project is it's just a continuation of the business we've built. So as I said, we're currently producing more than 4 million tonnes per annum. The Iron Ridge mine, which is owned by Fenix but sits in the middle of the Weld Range, is currently producing 1.4 million tonnes per annum. And we designed the Beebyn W11 mine, which is running at 1.5 million tonnes per annum, very cognizant of the opportunity we may have to accelerate our production. So we are now looking at how quickly we can build up production from W11, because we no longer have 10 million tonnes to mine. We have 20 million tonnes of resources in that deposit and a whole range of other deposits in and around it. And so we will, as rapidly as possible, be looking to complete that feasibility study and outline how quickly we can increase our production. But importantly, if people ask, when do you expect first production from this agreement? I would effectively say, well, we started production in 2020 when we started the Iron Ridge mine, because that sits in the middle of the Weld Range. Haulage trucks are currently carting ore from the Weld Range to our port facilities at Geraldton. This agreement gives us the opportunity to continue that for a very long time in the future and rapidly expand it.
So just on that production, you've previously described an ambitious vision for Fenix to become a 10 million tonne per annum producer. The agreement with Baowu contains an obligation for Fenix to produce at least 6 million tonne per annum, and the target being 10 million. When we did last week's webinar, you were all excited because you tripled production from 1.4 million to 4 million tonne per annum, but now seem to be aiming to triple production again. So how realistic is that ambition? And can you outline how you can achieve that?
Yeah, look, I think it's a very realistic ambition. As I've said, we've been working on this for a long time, and it's incremental expansion. So Mount Gibson produced 8 million tonnes in a year that they were running the Tullarin Peak mine and the Extension Hill mine, and they had only some of the on-wharf storage facilities that Fenix now owns and controls. Carrara, a fellow Midwest miner, are doing more than 8 million tonnes a year through their berth and storage facilities at Geraldton. We know that we have the capability of doing 10 million tonnes or more from our port facilities. And then we have significant, we obviously own the 2 rail sidings that Mount Gibson were using to haul and then rail those tonnes into Geraldton. It's an entirely realistic proposition. It will be supported by the detailed feasibility study we're doing. The challenge is not whether we can do 10 million tonnes a year. I think the 2 challenges for Fenix are how many more can we do above 10 million tonnes, and how low do we think we can get our cost of production. So we are on a journey from being a low volume, relatively high cost producer, now with a very clear ambition to be a larger volume producer at a much lower cost. And that's a very realistic proposition.
So does the acquisition change the guidance that Fenix provided recently for the financial year 26?
Not at this stage. So we're maintaining our guidance for the current financial year. As of this morning, we're operating 3 mines, Iron Ridge, Beebyn W11 and Shine, and we're targeting 4 to 4.4 million tonnes of production. That hasn't changed, and neither has our haulage rates. But we are actively now working on a feasibility study which will outline how we get to our target of 10 million tonnes per annum and how quickly we can get there, and most significantly, what that will do to our cost structure.
Now, the Weld Range project hosts a mineral resource estimate of 290 million tonnes at 56.8% iron. You've also described in the announcement the project's potential to produce high-grade and high-quality iron ore products similar to Iron Ridge and Beebyn W11. How should we think about the grade and quality of the deposits that make up the Weld Range project?
It's a good question, Mick. 290 million tonnes is a lot of material. The first thing I'd say is it's not that we're very confident, based on our due diligence and our long experience in the Weld Range, that there are in fact a lot more tonnes to find. And many of those deposits are open, and many of those deposits have really obvious benefit from further drilling activity. But the first thing to say is obviously we've got enough material already to aim at. The global resource of 290 million tonnes averages a grade just below 57%. But you can see in the information we've released today, I think the announcement is more than 80 pages, and a lot of that is geological information. To answer your question, there's some really useful information in the announcement in the grade tonnage curve, and there's also a table, I believe, in Appendix C, which demonstrates the numbers. So while 290 million tonnes of the resource at a 50% cutoff grades just below 57%, if you increase that cutoff, there's more than 100 million tonnes at around 60% iron ore. So one of the decisions we'll be making in the feasibility study is what product or what range of products do we want to target. But certainly there is tens of millions of tonnes of DSO material of a similar grade to what we're currently producing. And you've seen the flexibility that we have as a company at Shine, where we produce a high-grade lump and fines product, but also a low-grade fines product, which is proven to be very successful. And I suspect that we will be able to target both high-grade and low-grade products out of the Weld Range. These are a number of easily mineable, low strip ratio deposits, and many of them have grades similar to the grades that we're currently mining.
And the announcement also refers to some future partnership endeavours and mentions the potential for some longer-term commercial arrangements with Baowu that may include large-scale magnetite projects and green steel initiatives. So given the scale of what you've described already, are these opportunities real?
Absolutely. Baowu Steel are the world's largest steel maker. Their resources are incredibly deep, and their focus is very strong all through the value chain, including green steel, green iron. Fenix, though, we're very focused on what we're currently doing. We have investments in Athena. We can see the opportunities. I mean, what does it tell the market when the prevailing index, the 62% iron ore index, is weeks away from changing that entire index down to 61? So high-grade ores are less and less available. The market is showing a premium for quality. There's a move towards lower emission steel technologies and therefore lower emission iron ore products. And Fenix is ideally situated with the Weld Range project resources and our partnership with Baowu Steel to exploit those changes in the market.
Now, we've got lots of questions coming through on the system. Just a reminder, if you would like to ask a question, there's the Q&A icon just at the bottom of your screen. So click that and follow the responses. So John, we'll get into these. We'll get through to as many as we can. So James Williamson from Bell Potter, he's posted a couple. So his first one is, how soon can the 6 million tonnes per annum production target be achieved? And what are the main execution risks? And what are the potential penalties if the 6 million tonne per annum target isn't achieved?
Thanks, James. There is no penalties if we don't produce a certain 6 million tonnes a year. We've committed to use a best endeavours basis to get to 6 million tonnes and more as quickly as we possibly can. It's a carrot approach rather than a stick in this agreement. If you look at the royalty regime, it provides a clear benefit for Fenix. Effectively, the higher volumes we can produce, the lower royalties we pay. So there is a benefit rather than any penalty. How quickly we can get there, we're very motivated, and that will be obviously the subject of the feasibility study.
He continues on. He says, what additional infrastructure is required, mine, haulage, port, and what are the estimated capital costs? And is Fenix up for the total capex? And if so, will Fenix recover capex throughout the life of the agreement?
Fenix is in charge of our own mining activities. So I'll answer the end of the question first. It's unlike the original 10 million tonne right to mine agreement, which was effectively based on a 50-50 joint venture. This isn't a joint venture. This is an exclusive right to mine. But the beauty of the arrangement is that the answer to the first half of the question is to continue our existing business requires no change at all. So this isn't a feasibility study where we're starting with a hill and need to build transport infrastructure and port infrastructure and target first production. We're already producing iron ore from the Weld Range, and this agreement allows us to continue to do so. The capital that we may talk about is about how quickly we can expand and reduce our costs. And there are three real big opportunities to do that with larger scale mining, shorter haulage routes on private roads with larger gear, and then looking at shipping efficiencies and specifically transshipment. But there's an ongoing innovation across our value chain. So, James, the reality is we will be continuing our existing business and then transforming it as quickly as we can and as efficiently as we can to build a higher volume, lower cost version.
So that might almost answer his third question. How will unit costs trend as scale increases from 4 million tonne per annum towards that 10 million?
Well, I've mentioned that we've been working on these opportunities within our core businesses for some time. And so the ambition to be a 10 million tonne a year producer, we've spoken about a lot. We believe it's possible at those sort of volumes to target a C1 cash cost below $50 Australian a tonne, FOB Geraldton. Bearing in mind, we're currently doing a really good job to achieve in the mid-70s. So that's an ambitious target. It needs to be supported by our detailed feasibility study, but that gives you an idea of what we think is possible. And we are very motivated to be a low quartile cost producer. The Western Australian landscape is full of large volume, very low cost iron ore producers. The advantages we have in the Midwest is that we're in a blue ocean. We have high grade products and we own and control our own infrastructure.
James continues, is what are the key steps and timelines to get to the 10 million tonne per annum aspiration? Are any major port upgrades required to help Weld Range production beyond that 10 million tonne per annum?
Obviously, the key steps will be outlined in the feasibility study. There are no major infrastructure requirements from the port. I mentioned that Mount Gibson and Carrara have both been high volume producers out of Geraldton Port. The PMAX project, if you go on the Midwest Port Authority website, they're really clear in identifying the volumes that they think is possible to export from Geraldton. And that is very supportive of our ambitions to do 10 million tonnes a year or more.
And then can you run through the rough characteristics from each deposit? How many are there? Are they similar to Beebyn W11? And how do you plan to schedule each incremental new deposit?
Well, I can do that, but it would probably take as long as it would take a reader to get through the 80 pages of geological information in our announcement. I think there's a really good snapshot. If you just look at figure 2, you can see our Iron Ridge mine and our Beebyn W11 mine and how it is surrounded by the deposits of the Weld Range project that we now have an exclusive right to mine. In the announcement, we have included some pit shells, so you can see the layout. There's some cross sections. To come back to the earlier question about the grade tonnage curve, We have an opportunity to blend these various deposits, to decide on the products that we will produce and the order in which we open and close these pits. But the most obvious answer is W11. We're mining it at the moment. We will now look to accelerate that mining rate to increase our overall global production. And there are some really obvious, if you look at the pictures, you can see where the incremental development of the next pits will come from. And this is a multi-decade mining opportunity. It's very exciting.
So the last question from James, and we appreciate his input this morning. He says, beyond hematite, what else does this expanded agreement with Sinosteel open the door to in the Midwest?
Well, James, we've got 300 million tonnes and more of hematite iron ore. So we're as I just said, we're going to be mining it for decades to come. I think that, look, the agreement is quite clear in this is a broader economic collaboration with Baosteel and Sinosteel. The expansion of our infrastructure, when I talk about doing 10 million tonnes a year and doing it at a much lower cost, there is no doubt that that will provide an opportunity to change the cost base of other projects around us and other commodities. But the most important opportunity for Fenix and for the Midwest and Western Australia is to build an iron ore business of scale. And that will create multitudes of other opportunities.
Okay, then this one from shareholder Jen. She says, excellent announcement, Team Fenix. One question for the webinar. Is Fenix looking at using transshipping from Geraldton? Is it even feasible and would it reduce costs?
Yes, and in fact, I know that there are some very keen boat spotters who look at the ship movements that are publicly disclosed in and out of Geraldton. So Fenix, in partnership with the transshipment company CSL and our partners in Geraldton, the Midwest Port Authority, have just completed a transshipment trial using the Whyalla, a boat that has come around from Southern Australia. And we opportunistically have been using that along with CSL and Midwest Port Authority to trial transshipment. And that's, as far as I understand, that's the first time that that's been done out of Geraldton. So we have just dispatched a vessel which we topped up effectively. We're limited to loading Panamax boats with around 60,000 tonnes on berth 5 with access to on-wharf storage facilities. But the boats can usually take around 72,000 tonnes. So the Whyalla transshipment has topped up that boat, demonstrating that capability and effectively that reduces shipping cost. So that's a really great opportunity. The short answer you asked for, Mick, is yes. We not only see transshipment as an opportunity, it's one that we've already started. And I think that's a good demonstration of when I say we've been working on the opportunities that this agreement provides to Fenix for some time. The transshipment trial that's just been conducted, and anyone who's in the Midwest or particularly Geraldton will know that weather over the last week's been pretty challenging. So we've got some really good data and we're really pleased that the Midwest Port Authority and CSL, along with the Fenix team, have conducted a safe and very successful trial which demonstrates the benefits and opportunity that we see from future transshipment.
And a couple of questions coming through from Michael Bentley from MST East Star Services. Mention is made of the 3 mines for initially focus on in the FS. Does this imply you can see these coming online, expanding earlier than the 2 years as noted in the announcement?
Short answer is yes. We earlier mentioned that guidance remains in place for this year, and if and when we change that, we will immediately notify the market. But the opportunity is there. I mentioned that we designed Beebyn W11 aware of the opportunity we may have to increase its mining rate from 1.5 million tonnes per annum to 3 million tonnes, and that would create an immediate increase in our available product inventories. That needs to go hand in hand, obviously, with our integrated supply chain. So the new haulage fleet and port and shipping schedules. And that's some of the near-term work that we're doing, looking at the current financial year. And that obviously dovetails into the longer-term feasibility study. So stay tuned, Michael.
And the second one from Michael, do you have any early indications on the CapEx that might be required to get to 10 million tonne per annum? Also, can you give a bit more detail on the haul road and what that may involve?
The exciting point to make is that the pathway and the investments we will potentially make to get to 10 million tonnes are entirely in our own control. So the first thing to say is we're currently producing 4 million tonnes per annum. To maintain that production or even to increase it really only requires sustaining capital investments. Where we will look to do capital investments is where we can see a capex to opex trade-off. And I mentioned earlier the three obvious ones is increasing the scale of our mining activity, using bigger diggers, bigger trucks, and therefore getting better efficiency on a unit scale. The haulage opportunities that Michael refers to is the ability to shorten our haulage route and increase the tonnages by using private roads. Currently, the new haul fleet runs on public roads, and that limits us to around 150 tonne payload. Now, the construction, we've just built a very successful private haul road. It was the second private haul road we've built, and it's roughly 20 kilometres connecting Iron Ridge to Beebyn W11. Building a much longer private haul road connecting the Weld Range to, for example, potentially our rail siding at Riverdini or some other convenient location has the potential to significantly reduce the haulage route as well as being able to run much higher scale gear. That's an opportunity the New Haul team have been looking at for more than 2 years. The investment that Sinosteel and other forerunners of theirs made in the Oakajee port and rail development are very relevant to looking at that opportunity. So the answer is obviously any capital requirements we're making will be outlined in the feasibility study, but most importantly, our existing business and the continuation of that business doesn't require significant capital investment.
And just on that, from an anonymous attendee says, when is that feasibility study for the new assets likely to be completed?
Well, Goran Seat is one of the most hard-working individuals in Western Australia. I think he's Fenix's head of projects. You know, I think at this stage, depending on the scale of what we decide to do and how aggressively we approach capital investment will drive the timeline. But I would be hopeful that we'll be able to get feasibility study in the market in the third quarter of the current financial year.
And this is the third one from Michael Bentley from MST. Says approvals, having got approval for W11, does that mean the approvals for any additional production could be faster, or are they already in place?
Look, W11, it took us 18 months to get full environmental approval and to confirm and negotiate the heritage clearances we needed and the mining approval from the department in Western Australia. I think that's a pretty reasonable timeline looking at peer groups in Western Australia. There's no doubt that in all the commodities, the big and small mining companies are finding a huge advantage for incremental development. So we've been very successful with our approvals and partnerships that have sustained the Iron Ridge mine. We've demonstrated we can successfully get the approvals we need for Beebyn W11. And we would expect now that we're in the Weld Range, and again, look at figure 2, that the incremental approval process is very similar to what we've gone through at those two mines, and we're very confident that we'll be able to open up these new deposits in the timeframes that are required.
This one from another anonymous attendee. Does Sinosteel have any further deposits outside of these assets that are potentially available?
They do, and I think the big project of theirs is the Jack Hills magnetite project, which is about 100 kilometres north of the Weld Range. So if you refer back to the bankable feasibility study that Sinosteel completed, I think in around 2008, their plan was originally to do 15 million tonnes a year in hematite from the Weld Range project that Fenix have now got an exclusive right to mine on over a 15-year period. And that was really a ramp up to the rail and port infrastructure they were planning to use for the Jack Hills magnetite project, which is billions of tonnes of magnetite. So the collaboration that this agreement refers to is really looking at the other investments they've made and how the port and transport infrastructure that we're developing might lead to even greater collaboration on other deposits that they own. They have other hematite deposits as well, where we're ambitious. And so although 290 million tonnes sounds like a lot, from both sides of this agreement, from Baosteel, from Sinosteel and ourselves, there's a lot of opportunity for continual collaboration and continued expansion.
And at the other end of the scale, Peter Parker says, is there a minimum tonnes you must produce a year?
Well, I think, look, there is no hard minimum. We're motivated to produce as many as we can. There is a requirement for us to do 2 million tonnes per annum, or effectively we pay a prepayment of a minimum royalty payment. But given our current production is out of the Weld Range is already significantly more than that, we don't see any real risk of us being under those minimum tonnage requirements. It's really around, as I described earlier, incentive for us to reduce our royalty payments and a best endeavours basis for us to produce as much iron ore as possible.
And then Greg Oaten says, hi, John. I noted today's announcement there is a 6 million tonne per annum minimum target under this deal with Sinosteel Midwest. Is that 6 million tonne per annum in addition to the now 4 to 4.4 million tonnes per annum run rate, i.e. 10 million tonne per annum total? And secondly, what is the planned ramp up period? You always have a detailed plan. Go you good thing, he says.
Thanks, Greg. The tonnages and the royalty regime, although this agreement is separate to the 10 million tonne right to mine, the royalty regime and the rates are actually including the tonnages we produce for W11. And that's just to make sure that we're not incentivised to not mine that 10 million tonnes and mine some other tonnes on the Weld Range. So in terms of the royalty driver of production, it will include the rate that we're mining at will include the W11 tonnes, although those 10 million tonnes are subject to that earlier agreement. I think that answers the question.
And then JD says, hi, John, congratulations on the acquisition. The only mild criticism I've seen floating around is that the production royalty plus profit shares seem a bit high for this type of transaction. Would appreciate some detail on why you think this is great value for Fenix and whether you're expecting significant decrease in margin per tonne post royalty profit share.
So I'm not sure what comparables are being looked at here. I'd be really confident that the recent transactions of high quality direct shipping or hematite projects, which are attached to existing infrastructure where they can be monetised, are generally many multiples on what we're paying under any reasonable assessment on a per tonne basis. I think this is an absolutely cracking deal for Fenix. And I'm sure that there will be analysts looking at what we've paid in terms of if you think about the terms on the 10 million tonne right to mine, which we paid $1 a tonne up front for, so $10 million in cash. If we replicated those terms of this agreement, we'd be paying $290 million in cash today. So I think there's some really obvious advantages. This is a fixed royalty. It's a 30-year agreement. It's not indexed. I think you'll see that the royalty rates we pay on a percentage basis are going to be insignificant. At our current cost structure, we've generated probably an average of around $30 cash flow margin on every tonne we mined from the Weld Range. Times that by 10 million tonnes a year, times it by 30, and then compare that back to what we're paying in royalty and upfront payments. I'll just say it again, this is an absolutely cracking deal.
Then Alex McKillop asks, have you considered converting the haulage fleet to electric rather than diesel?
Good question for Craig Mitchell. The answer is yes. At the tonnages, and the very short answer is there is no one who believes that there's an electrical solution for 200 tonne trucks or more across a 1,000-kilometre round trip. We're looking at other opportunities to reduce our carbon footprint, and that's an opportunity that you should stay tuned for.
And this one, I think that's Gray Bookman, I think is the pronunciation. John, this deal is big news for the Midwest. What is the social gain this deal creates for Geraldton and the surrounding region?
It's a really good question. We're proud that we've created more than 300 jobs in the Midwest. We actively participate in the community. This is I've said it's a game changer for Fenix. It's a game changer for the Midwest. People will remember the decades of iron ore alliances, the Midwest, the companies that have worked on creating an iron ore business of scale. So this is a responsible and already successful company that now has a runway to continue to provide high quality jobs, invest in infrastructure, and not just the infrastructure that supports our mines. We're talking about improving the housing crisis in Geraldton, supporting the local communities, being partners with the traditional owners of where we work, and dovetailing with the very important investments the state government are making in key infrastructure, specifically the Midwest Port Authority, also working with Main Roads to make our roads safer and putting more money into that. There are wonderful community benefits for the Midwest.
And this one from Matthew Friedman, he says, is there an opportunity to redeploy equipment infrastructure from Iron Ridge as mining activities as that operation wind down? And do you expect that will reduce capital requirements as you grow production from the right to mine area?
Well, bearing in mind, as I mentioned earlier, that Fenix raised a total of $15 million to commission Iron Ridge, and a lot of that investment went into road infrastructure. So I think the obvious one for us is the private roads we're building are incrementally more important as we get more tonnage and provide more transport infrastructure. I think the opportunity in mining is for us to change completely the scale at which we mine and therefore the unit cost basis of that. So there wasn't a huge investment in mining infrastructure in relation to Iron Ridge. And we're already getting the benefit of that infrastructure, though. We have a camp there, and obviously we've expanded that camp now to cater for the additional people we need at Beebyn W11. And there's no doubt that the incremental expansion of our mining activities is supported by the footprint that we already have.
Raymond Wang says, I think you mentioned in the last call that the haulage road may have a limit because it has to go through the Geraldton city centre. Would you need to find/invest in an alternative haulage route to get to the 10 million tonnes per annum if the railway needs significant investment?
So, well, currently all of our tonnes travel entirely on public roads. I mentioned earlier that we've invested in the Riverdini rail siding. That provides us an opportunity to transfer tonnes onto rail, roughly 100 kilometres outside of Geraldton. So that congested section, which is really into and around what is the third largest population centre in Western Australia, is where we're looking for solutions as we increases our tonnage from its current rates. And the obvious one is to augment our road haulage tonnage with rail, and we're very keen and already working on that opportunity, and that provides more than enough future volume for our needs.
Just a couple of quick ones to finish off from Donald Payne. What is the additional cost per tonne for transshipping?
Oh, look, that's a detailed question that needs to be covered in a feasibility study. I think the way to talk about that, though, is at the moment people will be aware that shipping in Panamax boats has been averaging around $15 a tonne, sometimes more. If we were able to load much bigger boats, and particularly Cape-sized vessels, that shipping rate would roughly halve. So there's an opportunity in Australian dollars to reduce our shipping cost by potentially $15. Now, if the OPEX on transshipment is going to be single-figure numbers and hopefully low single-figure numbers, that depends on the trial we've just done with CSL, the type of vessel, and the commercial arrangements. But hopefully that response gives you an idea as the size of the prize is not really related to the OPEX. It's more about the potential reduction in our shipping cost. Obviously, that's outside of C1, but it effectively, any change we make to that increases our profit margin considerably.
And then Peter Parker says, do you have an idea how much you would forward sell?
We've got a very successful risk management policy and hedging. It depends on the prevailing iron ore price, but there is no intention to change that policy. It's been very successful. We lock in a positive margin where we can, opportunistically, as far forward as we can. It provides certainty and stability. But I think the key thing about this morning's announcement is what we at Fenix have always said. Our biggest hedge against the iron ore price is to reduce our cost. And so while, yes, we will continue to maintain the risk management policy in relation to pricing that has proved successful for Fenix, the exciting and the really important thing about today's announcement is we now have a pathway to a much lower cost iron ore producer. And in an environment where the iron ore price continues to stay around $100 a tonne, that provides such a wonderful and exciting opportunity to be an incredibly high profit, high revenue business.
And we've got time. He's going to squeeze one more in again from Matthew Fryman. He says, with regards to Sinosteel's rights for offtake, how frequently do you have an opportunity to test price against potential third-party buyers? Or is it a one-time nomination as to whether Sinosteel or third parties will take the offtake?
It's a good question. We're really comfortable. This agreement continues what we've used previously, which is effectively a right to match. So one of the key things that our partner is looking for here is supply. And obviously, Sinosteel, and particularly their owner, Baosteel, the world's largest steel maker, is really looking for the material. In order to protect us on the pricing side, we have a right to match system. So and the answer to Matthew's question is, that depends on what we could sell it boat by boat. What we've actually been doing for practical reasons is going out with big parcels, and we're actually currently marketing 12 months of production from Iron Ridge. And we look for off-takers, and then we provide our partner with a right to match. So it's got a lot of flexibility, and it's under our control. And so I would encourage the market to have confidence. If you look at our quarterlies from inception, we've done remarkably well. We won our, as a small company, a bit like the way we own and control our mining activities, we own and control our haulage activities, our port services. As a small company, it's quite unusual that we're so active in marketing our own iron ore. But I think if you look at our achieved iron ore price compared to the index and the quality of our products, we're doing really well there. It's another value generator for Fenix, and this agreement allows us to continue to capture that value.
Yeah, great. Thanks, John. And thanks to all the participants who did put questions in. And again, if we didn't get to yours or you do have questions, just go to the contact page on the Fenix website. Now, John, any closing comments this morning?
Really exciting. 290 million tonnes of hematite iron ore in the Weld Range all around us. We're working hard on a feasibility which will clearly outline a pathway to Fenix being a 10 million tonne a year producer at a much lower cost. It supports our existing business. We're still producing iron ore today. We've just published another profitable year where we're paying a 1 cent dividend this year. I think shareholders should be really confident that our ability to build a scalable business will see those numbers be dwarfed by future potential. So look forward to continuing to outline our pathway. And thank you very much for joining today's webinar.
No, exciting times ahead. Thank you, John. Again, thanks to everyone and enjoy your day.